Hi, in this screencast I'm going to run through the 3 statements that you're commonly asked to prepare for a set of accounts for a company. So a normal type question relating to company accounts gives you a trial balance, like here. Trial balance at the end of the year, and these are all the accounts at the end of the year. It's got some notes. And then the typical requirement in these type of questions is to prepare the income statement for the year, the statement of changes in equity for the year, and the statement of financial position at the year end. So they're the 3 things in a question. It's only a page like that, and you have to do the 3 statements. And to do that, you need to know the format. So I'm just going to run quickly through the format for A, B, and C. So here is the income statement format. And it's always this format, this number of lines, revenue, and if you have a working to do, you just show the working kind of alongside it. For example, here if I look at question and a different question, the income statement, the cost of sales is a working for it. You can show it in brackets there. So let me say that should be revenue. Revenue minus cost of sales, gross profit, other income. And if you have a working, you can just show the working beside it. So but for now, here's the format. Revenue minus cost of sales. Cost of sales could be made up of these items. Purchase as returns, depreciation, inventory, and closing inventory. So you could potentially have 1, 2, 3, 4, 5 items going into cost of sales. Other income, we're looking for things like grant, rent received. Distribution. In most questions, in any questions we'll be doing, the trial balance will have already collated the type of accounts that go into distribution, such as these, into one account called distribution. So if we look back at the question in the trial balance here, there are distribution expenses 7.5 and admin 6. So that'll already have been done for you. But these are the type of costs that go in to these. Investment income, income from investment. So if you'd invested in shares and got dividends, or if you'd received interest on an investment, deposit in a bank. On interest paid, all types of interest paid. It might be interest in a bank overdraft, or typically it will be debenture interest and in tax. So that's the income statement format. The statement of change in equity. So equity is what belongs to shareholders in a company, or what's owned by shareholders in a company. And what shareholders own are things like share capital, where they've bought shares, share premium, when they buy the shares, if they've paid extra for the share than what its nominal value is, that goes into share premium. And preference shares are another type of share, usually with non-voting rights, and a guaranteed dividend that's paid every year. Whereas ordinary share capital, you get voting rights, you're allowed to vote at the annual general meeting and in any extraordinary general meeting, but dividend rights aren't guaranteed, and it's up to the directors whether they pay out an ordinary dividend or not. And then what else belongs to the shareholders are the profits. So retained reserves or retained earnings are the profits that are saved from this year and previous years. And you may have any other type of reserve. So a reserve is another type of profit that's been moved into another location to save for something else. So here they're taking account of a possible revaluation in the future. They're just moving profits from their general profits or their retained profits into another type of savings account, more or less, or it's a profit account. So you start with the opening balance, and the opening balance is normally given in a trial balance. So what I mean by that is here at the start of the year is our ordinary share capital, our share premium, preference shares. Those amounts go in to the statement of changes in equity in the beginning and the opening balances. And then we take away, adjust for movements during the year. So, for example, in this question, the retained earnings at the end of last year, the start of this year, 2,472,000. And if the company has made a profit in 2016, those profits should get added to last year's profits. And that's what's shown here. And it's the profit after tax figure from the income statement, and if it was a loss, it would get taken away, but you just carry the figure down. And then, if the company decides, if the directors decide to pay out a dividend, dividends reduce the profits. Dividends are a payment of profits to shareholders. So that's why dividends are taken away here, or deducted from the reserves, because they're reducing the amount of profits that are kept in the company. And there's different types. An interim dividend is one that's paid during the year. It's a one-off dividend that's decided during the year. A final ordinary dividend is if the directors decide after year end, once the accounts are prepared, so it might be 10, 12 weeks after year end until they know if they made a profit or loss, then they decide, okay, we'll pay a dividend for the year. And an example of that is here in the notes, a final dividend of 3 cents per share declared by the directors. So what that means is the number of ordinary shares gets multiplied by 3 cents to work out the dividend. So at the start of the year, this was the share capital, the ordinary share capital. There were no shares issued during the year in the notes, so they haven't changed. So at the end of 2016, we have ordinary shares, 25 cents each, worth 11,200. So to get the number of ordinary shares, 11,200, each share is worth 0.25. So there's, for every euro worth of shares, there's 4 shares going into that. I've multiplied that by 4, or else the easier way is, or another way of doing it is to divide by the nominal value. So the shares are worth 11.2, divide by 0.25. And that's going to the same thing as multiplying by 4. So there were 44,800 ordinary shares in issue. And the directors have declared a dividend of 3 cents per share, I think. Let me just find it down here. The final dividend is 3 cents per share. So the 44,800 multiplied by 0.03, the dividend will be 1,344,000. So 1344, and that's what would get shown here as a deduction in the final ordinary dividend if we were doing question 2. Preference dividend is the value of the preference shares multiplied by percentage. And in the question, that's as straightforward as finding your preference shares. There's no new ones issued during the year this year. So that's the value of the shares at the end of the year. So they're a bit like a loan. They're a payment of 11% for each euro worth of shares. So 11% multiplied by 3,600. $396 would be the preference dividend, and that's what will get shown here as a deduction. Transfer to reserve just means the directors decide, okay, we'll take some of our savings which we've got here and just put them into another savings account, and the savings account they have is a revaluation reserve. So you're just putting money aside that you're going to need in the future for some particular thing. And in question 2, it needs to tell you in the notes that there is a transfer. So 190. So you would show minus 190 coming out of the savings and plus 190 going into reval reserve. And then, so up to now, you'll notice that the only thing that's been affected has been retained profits. So your profits at the end of last year, add this year's profit to it, and then take away dividends, and then take away transient reserve, which increases the revaluation reserve, or the other reserve that you've moved the profits into. So they're the two columns that have been affected. The only way there's an adjustment to ordinary share capital, share premium, or preference shares is if there is a share issue during the year. And in these questions we're doing, there's not going to be any shares issued. So we won't be covering that. If you go on and do financial accounting in subsequent years, you'll meet issues of ordinary shares, maybe issues of preference shares. But for us, we don't need to concern ourselves with that this year. And the closing balances then is just, for ordinary share capital, share premium, preference shares, it's going to be the same as the opening balance because we won't have any ordinary shares issued. It's kind of like you're not going to see, and if they're not there, you don't need to have them really. So your statement of changes in equity is going to look like this: your opening balances, and then adjustments to retained reserves, or retained earnings it's sometimes called, and then the transfer to the other reserve, whatever that might be. It could be building reserve, or general reserve, or acquisition reserve. If the company thought they were going to buy another company in the future, they might be putting money aside each year to build up savings in this particular area. So that's part B, statement of changes of equity. And the third statement is the statement of financial position. This is where we show the assets, what the company owns, and then the equity and liabilities, which tells us where they got the money to buy those assets. And where they got the money, well, they got so much from shareholders. The shareholders have invested this much in share capital. So the shareholders have given that money when they bought shares in the company, and the shareholders have decided, or the directors, what the shareholders give the directors the right to decide on their behalf, to keep those profits in the company as well. So the profits and the share capital, they all belong to shareholders. And then where else we got money to buy those assets was any liabilities. So debenture is a long-term loan, and current liabilities, short-term borrowings, and payables and outstandings at year end. And these are the common things that are shown in payables and not trade and other payables. So expenses due, so admin expenses due, or distribution expenses due. If there's preference dividend outstanding at year end, ordinary dividend outstanding, taxation outstanding, interest on preference, or interest on debentures outstanding, they go in there. So our non-current assets, just to run down through this pretty quickly, are divided into three types. So these are long-term assets, greater than a year assets you expect to be there in more than a year's time. Tangible means physical. You can touch, kick, see. If you ran into it, you'd hurt your knee, you know. So property, plant and equipment, land, IT equipment, computers, those kind of things. Intangible assets are non-physical assets, such as patents, trademarks, brands. So the Apple brand is worth billions. Other companies that may not be doing so well, their brand wouldn't be worth as much. Patents gives you the right to be the sole distributor or sole manufacturer of a certain product for a period of time, if you're the first there to invent it, and that's worth a lot of money. Goodwill, if you pay more for a company than its physical assets are worth, well then what did you pay? Why did you pay that extra bit of money? And the reason is, in accounting, is classified as goodwill. And financial assets are investments in shares. And intangible assets, generally, you're going to pick up quite easily in a question. It should say something like here, investment in shares. That would be financial assets. And there'd be 15. Intangible assets are the non-physical assets. and goodwill there is 657, and in the question you would show intangible assets 657. Tangible assets will need to do a working, because normally there may be a number of tangible or physical assets. So here are tangible assets, are property and equipment. That's what they cost originally. At the end of 2016, at the end of this year, they've been depreciated, because it tells us here the cumulative depreciation provisions are up to the end of this year. So that means property has gone down, has fallen in value, or we've used up, the company's used up 1,300 worth of the property, and equipment has fallen in value by 800. So you've a working to do for that, and the workings will look like here. There's your property, less depreciation, and that gives you net book value. So that's called cost. This column is depreciation, and this column is net book value, and you could put in the headings. And that 15,300 is what gets shown up here as your tangible assets. So tangible assets would be that figure. Current assets is inventories. That is always going to be your closing inventory, and closing inventory is always in the notes. And you'll notice I've crossed off the last 3 zeros in the notes, because that's the reason for that is for companies, and normally companies are, not all companies, but lots of companies, the company counts we'll be doing, the companies are going to be quite large, and so we'll have, the trial balance will have the figures in thousands. So the property they own really is 15,600,000, but we show the thousands up here, so you can knock off, the trial balance basically is knocked off the last 3 zeros and everything. So the investments in shares is 15,000, not 15. And so when we're doing the income statement and all the other statements, we just show the figures that are in the trial balance. But in the notes, because the notes are not in thousands, we need to cross off the last 3 zeros on everything. So our closing inventory will be 2,500, and that's what goes in to inventories. Trade and other receivables you'll pick up from the trial balance. Receivables, 15,000. And your prepayments will be in the notes to a question. So it'll have there are none in this question, but it might say administration or distribution expenses prepaid, and if there were, that's where you'd pick up prepayments. And cash equivalents will be in the trial balance, so you're looking for things like bank or cash there. Equity, you just pick these values from the bottom of the statement of changes in equity. So here, what we did, what the values we got here, just get carried down here. Non-current liabilities are debentures, which is our long-term loan, so non-current liabilities are liabilities greater than a year. Your debentures, and assuming none of that was paid back, and none of it was paid back in the notes, that's the loan that was there at the end of the year, 8,000. So it's just the full value of the loan that goes into non-current liabilities. Debentures, 8,000. And then you'll have a working to do for trade and other payables, because lots of things might go in here. So these are the things that fall under that. And short-term borrowings will be anything like a bank overdraft. And that is the format for the statement of financial position. So I hope that